Hello and welcome to this great investor edition of Wealth Track. I'm Consuelo Mack. Among the hallmarks of the great investors we have interviewed over the years are their penchant to view their investments as businesses, not stocks, and to buy at bargain prices no matter how attractive a company's long-term prospects. Most of these master investors insist on buying at a discount. The steeper, the better. This week's great investor is no exception. He is James Tisch, the second-generation CEO of Lowe's Corporation, a conglomerate founded by his father, Larry Tisch, half a century ago. Now, Lowe's has been brought to our attention by several Wealth Track guests, including value investor Chris Davis, who owns it in the Davis funds. As he told Wealth Track, it is one of those companies where there is no theme. It's not the home improvement company, but the Tisch's company that's been honorably and well run by the Tisch family for more than a generation. And hedge fund and mutual fund manager John Dorfman, who recently recommended it in his Bloomberg Businessweek column as one of my favorites in a group of 4 beaten-up stocks trading below book value. Why does it trade below book, meaning its corporate net worth, its assets minus its liabilities? Well, one reason is Lowe's is a conglomerate, so considered too complicated for most Wall Street analysts to follow. Kind of like that really famous collection of companies called Berkshire Hathaway, to which it's sometimes been compared. But its collection of businesses are far fewer than Berkshire's. There are only 5 of them acquired over the decades. 2 are totally owned by Lowe's, 3 are publicly traded. Its original, Lowe's Hotels, is 100% owned by the company. CNA Financial, a property and casualty insurance company, is 90% owned by Lowe's. Diamond Offshore, specializing in now heavily scrutinized ultra-deepwater drilling, is 50.4% company-owned. Boardwalk Pipeline Partners, a domestic gas transmission company, is 66% Lowe's-owned. And Highmount Exploration and Production, a natural gas exploration and production firm, is 100% company-held. Well, what is easy to understand about Lowe's is its performance. 16% annualized returns over the last 50 years versus the S&P 500's 6% returns. And that's the reason we are talking to Jim Tisch. We want to know how these self-described value investors have delivered those returns. I started by asking Tisch what value means to the Tisches.
It's an interesting question because a lot of people call themselves value investors. And as I think about it, I think of that famous Potter Stewart line about pornography. You
Yes.
know it when you see it.
Right.
And I would say the same is true for us and our brand of value investing. I can't quite put my finger on it, but I know it when I see it. And it means either buying businesses at low multiples, buying things that are out of favor. It definitely means buying things that you think have very little downside to it. But beyond that, I can't really define it so clearly.
But you know it when you see the company, and those are the kind of companies that you've purchased.
Yes, I know if it's a tech stock trading at 24 times earnings, chances are it's not a value investment. And if it's a chemical company that's trading at 4 times earnings, then it's very possible that it is.
So, Jim, your dad, Lawrence Tisch, Larry Tisch, was described in a Forbes article as blunt-spoken, buy-it-cheap financier, and he built a collection of companies that Lowe's purchased when they were down and out, unloved, the market hated them. So what are the lessons that you as the second-generation manager of Lowe's learned from your dad?
We have 5 different subsidiaries.
Right.
So when people ask me what do they all have in common, I all say they were purchased at attractive valuations, and that really is the case. So he was really the king of value investors.
And when you say attractive valuations, I mean, there's attractive and then there's dirt cheap. I mean, do you essentially look for companies that are, when we talked about unloved, are they practically distressed, or I mean, how cheap do you look for?
I'd put it to you this way: you like to buy businesses at cheap or dirt cheap valuations. Sometimes you have to settle for attractive. So it's really hard to find businesses that you can buy dirt cheap.
One of the things that Lowe's has done to create shareholder value is you have had a very aggressive share buyback program. And what is it, 25% of your shares are bought back every decade?
Yes. The statistic is that in 1970, we had split adjusted 1,300,000,000 shares outstanding. Today, it's just over 400 million. And in each decade, each of those 4 decades from the 70s to today, we bought back at least 25% of the shares outstanding at the beginning of the decade. And the reason for it is really simple. Notwithstanding the returns that Lowe's shareholders have gotten over the past 50 years, which is about 16%, the stock still tends to trade at a big discount. And so we have this, what I call, long and glorious history of share repurchase. Buying back shares, not every day, but at times when we think it's particularly attractive. And we do that not to make up for shares that have been issued under option plans and the like. We do it because we think it's really cheap and it's good value for Lowe's shareholders. And so that share repurchase program, my guess, is responsible for at least half of that 16% total return that we've had over the past 50 years.
What's the benefit of the share buyback versus paying dividends?
Lowe's has never been known as a dividend-paying stock or a yield stock. And we have a corporate philosophy at Lowe's that we need a full treasury. We need cash in the treasury in order to be able to do things. It's what allowed us to get into the shipping business. It allowed us to get into the drilling rig business. It allowed us to get into the gas exploration and production business and the pipeline business. And it's also allowed us to repurchase our shares. And we believe that by having that cash and having that flexibility, there are things that we can do as a conglomerate, as the management of a conglomerate, that generates long-term value for all of our shareholders over time.